Welcome back to Business Day. As we've been saying, gold and silver pulling back a little bit in trading today, but the drop doesn't really come as a surprise to our next guest. He says the metals are overdue for a correction, and that silver might even carry twice the risk as that of gold. Joining us from New York is Jon Nadler, a senior metals analyst at KITCO. John, very good to see you.
Good to be here.
John, I love it when people come on and speak a little bit of heresy. You're not convinced right now that there's further upside in gold and silver?
Well, it's not about that. I think we could always go along with the Goldman forecast for $1,750 gold inside of 24 months and so on. But really the question does arise, are we going to chase the last 25% for the next 2 years after we've had a six-fold increase over the last decade? I'm not so sure. And they were the ones, by the way, who called it a compelling trade but not a very good long-term investment, with which I disagree, because in fact gold is very good insurance over the long run. That said, let's face it, the trade has been extremely crowded. Smugness was at an all-time high. Practically, we got to a situation really last week where any excuse was good enough to buy metals, good news or bad. And then suddenly, I actually expected to be here today talking about new records, but lo and behold, the dollar didn't collapse after the tax deal in the U.S. Someone took the pressure off the Fed to have to do any type of QE 2.5 or 3.0. And here we are. Profit taking is in order, perhaps more than we've seen, because basically we've not had a decent correction in gold or silver for the better part of 2 years, really.
It's interesting, though, John, because although silver doesn't capture the imagination in the same way that gold does, it seems to have more of an industrial complex than gold does, and yet you feel there might be more risk in silver than gold by comparison. Why is that?
Well, absolutely. I think if you look at the track record, I like to call silver gold on steroids, but it bears it out. Look, if you look at the last decade and an average annualized return of 9.54% for silver, that looks pretty shiny, really, perhaps more so than gold. But at the same time, that return came with a very high price, namely that silver carries twice the risk entailed by holding gold. If you stretch this out over a period of 25, 30, 40 years, the returns might match those offered by gold. But when you compare the whole list of assets potentially involved in a portfolio, it turns out that silver is the single riskiest asset you can carry in such a mix, while its returns are not at the very top of the heap. So caution is definitely advised. I would treat it as an adjunct to a core gold holding. And I would treat it as a trade, which is exactly what Warren Buffett did when he doubled his money in silver not that long ago.
Well, John, where do you see the timeline of this? We're obviously seeing the price of the metals falling today, but do you see this the beginning of a correction, or where do you think this may get struck out from?
Well, we may well be seeing the beginnings of a trend change. There's a convergence of factors here that I would certainly be on the lookout for, namely that, as I mentioned earlier, the pressure has now been relieved from the Fed to have to act with any type of hefty QEs going forward, which means that if the tax proposal and compromise actually works and the economy recovers faster and jobs are created faster, then of course the Fed might enact its exit strategy sooner than later. And Goldman put a timeline on the precious metals market for 2 years. I would be bold enough to go out and say, let's call that inside of 8 months to 12 months. The other factor that I would look out for is this campaign by China, which is now public policy, to tighten and to cool the economy. And, the CPI numbers in China come out on Saturday. We'll see if the central bank acts even before next week rolls around. And of course, a higher interest rate environment makes life more difficult for, spec players. Finally, I'd also look out for the fact that the dollar has broken out of its recent downtrend, and ultimately that doesn't bode all too well for, precious metals. The last component would certainly be the fact that position trading limits might come into existence courtesy of the CFTC as early as perhaps next week.
So, John, what is fair value for silver for you?
Well, look, at a time when we're talking about a $5 production cost for the metal, with a cogent case possibly being able to be made for a $15 to $20 trading range based on industrial consumption at the moment, I don't see it having much business anywhere between $25 and $32. So certainly in terms of a fair value and fundamentals-oriented price level, I think somewhere between 15 and 20 is reasonable to think of silver. I don't put much faith into the gold-silver ratios, by the way, on a historical basis, really.
John, we have about 30 seconds, literally. There's a certain investment bank that has enormous singular exposure to both copper and silver. Is there any danger that they could come asunder because of that?
There's that danger, but I see a bigger danger in the concentration of physical silver among the ETFs of the world. We're talking about almost 500 million ounces of silver being basically hoarded off exchange. Any type of leakage or redemption process out of those vehicles could present enormous price pressure in the market, which, by the way, as I said, is ill-prepared, just like gold is, to absorb additional tonnage of that type at a time when mine production is up, scrap supplies are up, and fabrication demand, industrially speaking, is falling.
John, that's a story in itself. We'll get you back to talk about that on another day, but we thank you for your time this afternoon.
Thank you for being here.
That was Jon Nadler, Senior Analyst at KITCO Metals. He joined us from New York.